All right, gang. Happy Wednesday. Welcome back to the Tier 1 Trading New York live trading room. Good to see you guys made it on time today. Yesterday, as predicted, we had a few people show up fashionably late because of the whole daylight savings time and whatnot. But we saw some good news that may be going away soon. But welcome, welcome, welcome. Happy Fed Day to you. We talked about it yesterday. We talked about it Monday. We have a heavy week of fundamentals coming out. Today, we have our ADP employment change at 8:15. This is a jobs number. This is typically thought of as the precursor to Friday's non-farm. Now, the formula for how to calculate this has changed a little bit, so we're not really sure if the correlation still exists, but that's going to take some time. But anyway, the market will be looking at this in order to project what they think is going to happen Friday with the non-farms. And then later on today, we have what's probably the biggest overall in general, the biggest fundamental announcement that is out there in any market, which is an interest rate decision. We talk about the gears of fundamental analysis and how there are big gears like interest rates that, kind of economics 101 is that's what kind of drives everything. And then the smaller gears are what affect the bigger gears and all that fun stuff. We've got an interest rate decision coming out today here in the US at 2 p.m. We know there's going to be a hike. What's more important than the interest rate decision, unless there's any type of big splash, which I don't think there will be, is going to be the press conference. Again, I don't think the market really cares about the interest rate hike. That's been banked into the market for a very, very long time now. What the market is still looking for is the pivot. And by the pivot, what I mean is that when are we going to change kind of our monetary policy projections? We've been going 75, 75, 75. When are we going to start slowing down? When are we going to reach the peak, I guess, of the mountain and start going back down the other side, right? Because that has to happen. And the question is when. So the market's going to be paying a lot of attention to the press conference afterwards, where Powell's going to come in and speak and probably give a very generic PR written speech that says a lot of something, but really nothing. But the Q&A portion of the press conference is always the part that is a little bit more interesting. That's when you can kind of get some non-rehearsed answers, I guess. It'll be interesting to see what the market does during that. So that's what's coming up for today. Two big news events. Now, the problem is for our trading, that basically means the markets are going to be at a standstill until that happens. So we call these golf days in the market, right? Golf days, or if you have any other type of hobby, this is, you see these days in advance. This is where you book around at your local course because you know nothing is going to happen. But we'll talk a little bit about what you can look for as a longer term trader. So we're going to start here because we're going to come in for a trade of the day. We always do that. And we're going to start here on the dollar Swiss. And first and foremost, yesterday, good predictions yesterday. If you guys remember, I felt bad for Cody because Cody missed his entry. But if you remember the pound dollar from yesterday, remember our fake break and boom to the downside? Look at that. Right to our projected targets, 1 and 2, even past it. Again, I felt bad for Cody because he missed his entry and had to watch the market go without him. But that was some good analysis right there. I'll actually put that video up later today on the YouTube channel. It's kind of a day trading walkthrough. I didn't have a chance to kind of film the dooring part because I was trying to do that new live room upload with the chat and everything, which took me longer than expected. But it ended up being a very nice move to the downside here. And then another one we talked about later in the session, if you guys remember it, was the dollar Swiss. I think it was the hourly. Yeah, hourly right here, right? We talked about, where'd you go, dollar Swiss? You're over here somewhere. There we go. We spoke about this right here. And this was an interesting conversation where we looked at this candlestick combination right here. And I remember we said, no no-brainer buy, just based off the candlesticks, based off our ability to read them, based off the story that they tell us. Now, this always brings up an interesting dilemma, because what we teach here and what I preach is rules-based trading. And there's always that kind of that disconnect between, we start off as traders and we think we know stuff. We don't really know stuff, but we think we know stuff, and then we get into trouble because we recklessly enter positions without really knowing stuff, and we lose money. Then we shift to a rules-based trading method where we have rules, they're tried, they're tested, they're verified, they're repeatable. We have something that is consistent in the market, something that has data to back it up, and we only stick to those rules. But as you gain more time in the market, right, because you're typically, if you want to become a consistently profitable trader, a successful trader, you need to spend a massive amount of time in the market. When you spend a massive amount of time in the market, your eyes and your brain is picking up lots of different things, even things you aren't consciously paying attention to. So as you get more experience trading, you get these moments where you see something on the chart and you just know, right? That's called intuition, right? Intuition isn't made up. It's not based off of feeling like you're having a good day, so you should buy. You're having a bad day, you should sell. So it's none of that crazy stuff. Intuition is basically stuff that you see, stuff that you recognize, a common occurrence that you can't quite put a finger on, right? Your brain has seen it before, so your mind recognizes it, but you can't quite define it. And you get these moments and you look at a chart and you're like, I just know. Like, I just know. Like, I can't explain the feel, but I just know we're going to go up. And that's part of that's the natural process of becoming a kind of a veteran trader. Now, the key is you have two choices. And I use Peter Brandt, who is not a friend of mine, but someone that I look up to in the industry. You have two choices on how to deal with that intuition. One, you can just say, I trust myself enough to kind of trade based off this intuition. I know that this occurrence is going to be rare. It's not a normal thing. So yes, I'm breaking my rules, but I'm only doing it this one time. It's not going to be a consistent thing of breaking my rules. Or you can identify why you're having that intuition, what it is you're recognizing, put rules to it, and now you can trade it without any psychological error. So it's a cool discussion on that as well. But you can see, again, nice rejections, boom, 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 boom. We actually did get the higher high, higher close. We never spiked down. So even if you did the aggressive buy stop, right, maybe a little bit of pain as we went down a little bit, but a straight shot up off of this combination. And this is a beautiful one. But we're going to stay on the dollar Swiss today for our trade of the day. And what I like to do on days like this, I call them Fed days, days we're expecting potential big moves in the market, is I like to ask myself a few questions, right? If we're going to see a big explosive move, where are the points that we're likely to go to? And I do this in my normal analysis anyway, right? My normal analysis consists of basically identifying key levels of support and resistance. And then my whole analysis is basically, if price goes up, we're going to this level of resistance. If price goes down, we're going to this level of support, right? It's really boring analysis if you guys are new. It's nothing fancy. It's not flashy, no bells and whistles. I'm just very good at identifying key levels of structure and predicting which ones we're going to go to next, right? Sorry to disappoint. I disappointed some guy the other day. He was talking to me. We were having this conversation. I think it was Instagram. And he's like talking about trading and all this fun stuff and picking my mind. What type of strategies and techniques do you trade? And of course, typical Keel, right? Not one for a lot of small talk. I'm like, yeah, price action. Okay, yeah, price action. I do price action too, and this and this and this and this and this. What do you use for price action? What type of technique do you double flip? Blah, blah, blah. I'm like, yeah, I look for support and resistance, and then I trade it to there, or I trade it once it gets there. He's like, okay, yeah, but what about the strategy? I'm like, yeah, that's pretty much it. Like, I have some advanced patterns in there. Like, I use some things, AB equals CDs, Fibonacci's. I use some tools, but it's really just trading to structure or trading off a structure. And you can see like his, I guess in a chat type of way, you can see like just him deflate. Like, he was so excited about getting like this super secret flashy strategy. And then I just hit him with the basics, like, support resistance. All right. But The truth is, the tried and true methods, that's what has worked in the markets for decades and decades and decades. I saw this video from Jason Greystone the other day on his TikTok. By the way, follow me on TikTok if you're not already. Short, sweet trading tips on there. And he was talking about just financial freedom, stuff like that in general, success in general. And he's talking about, don't try all this new flashy things. Don't try the necessarily the latest trend that comes up on the internet. It's simple. Just, study the most successful people in history, see what they have in common. And those are the things that are going to make you successful, right? If you study 10 people that have had massive success in whatever industry you want to study, and you see that these 10 people all shared this common trait, well, come on now, right? It's not that difficult. So I like to look for levels on days like this, where if we get a big explosion, where is price likely to go to? So we're sitting right here in the middle of really a big elephant candle. And let's say we were going to get a big move up. Where would you guys say we're likely to continue to if we got a big explosion? If we got big dollar strength, where are we likely to go to? What would you guys say? Previous structure right here is maybe a first level. Our next level of structure back here is maybe a second level. Would you guys agree with that? First stopping point, first stop sign, second stop sign. Go ahead and make these lines a different color. Blue doesn't really help us much. Right? Probably. All right. So if we go down, right, if the market dollar weakness for whatever reason, if we go down, where we like to go to next? Well, probably first stopping point right here. Maybe second stopping point either here or here. So what you're doing is you're identifying what levels do I need to pay attention to? And then you're asking yourself the question, would there or are there potential trading opportunities at these levels if we were to get a move? Because I'll tell you what's been happening in the market lately is we're seeing a lot of overreaction to news, not a lot of follow through. So we're seeing a lot of news spikes or whatnot. And then an hour later, we're seeing the market say, and goes back to normal, right? We're not seeing a lot of 100 pip moves to the downside and then continuations after that. We're seeing a lot of spikes and the market reevaluates, it overreacted, and we go back to normal. So if you're a counter trend trader, these are perfect areas to look for those counter trend plays. If we do get continuations, right, this opens up the opportunity where it's like, hey, if we break this level or violate this level, then we know our target for a continuation up. If we violate this level, then we know our target for a continuation down. So we can set up and rehearse these ideas in our head so that if this move does happen, and if it happens pretty quickly, we're not caught off guard, right? That's the biggest thing in trading. People get caught off guard where a move happens, they're not prepared, then they panic. When you panic, you're more prone to make mistakes. When you're more prone to make mistakes, you're more prone to lose money. If you're prepared in advance saying, hey, this level's on my radar, this level's on my radar. If we hit that, then I'm looking to do this, right? There's still going to be that thumping heart in your chest. Your fingers still may be twitchy with nervousness, but because you've rehearsed it, you already know what to do. Okay, if we get here, I got to wait for this. If we get that, then I'm taking this. If I do that, stops go there. Then you're more likely to do the right thing, less likely to make mistakes, less likely to sabotage your trading. So one thing that I had in mind for down here, because the opportunity to the upside there's nothing, there's structure up here, but it's not as appetizing as the downside one. So we'll focus on if the market moves down. We're close to having a cipher here, but we did get a close under the 1414, just barely. I should actually double check that on my Ninja Trader. Let me bring it up real quick. But I'm pretty sure this morning we did that. But sometimes the eyes are not as sharp first thing in the morning. They get a little sharper when I have my coffee. Vincent says Gartley pattern in the make. That's exactly what I'm eyeing up, Vincent. Well done. Professional guesstimation. Yeah, if we go to the downside, we're going to have that potential Gartley. Yep, that's exactly what we're going to talk about. Well done, Vincent. So let's go to dollar source for here. I'm going to go over to Ninja Trader for a second just so I can I got a software over here that I use to make life easier. So pardon me. But let's go to dollar Swiss. We are on the hourly or 4 hour, either one. And let's first take a look at this potential cipher. Because again, I don't think it's a cipher based on my measurements, but could be a little bit wrong. But let's take a look at this. X to A, swing high to swing low. A to B, our first retracement. B to C. Yep, we're going to close below that C leg. So that's going to be an invalid cipher. So what's on my radar here, if we go down to our levels, is this swing low from this VS1, that green box, to swing high is going to be our X to A. Vincent says, learn from you. Thank you. I thought you were going to say learn from the best. I'm going to say, who are you learning from? Who are you learning from, Vincent? Who is this best? X to A right here. A to B, which is going to be our, give me his number, please. I would like to learn as well. A to B. Now, this is very important, right? You can see the B leg. B leg hits, and this is why I want to use our software instead of just the fibs. The B leg hits the 61.4 Fibonacci retracement. Now, who can tell me what is the requirement for a Gartley pattern? What Fibonacci on the B leg? What Fibonacci level for the B leg is a requirement for the Gartley pattern? Who can tell me? Pop quiz. 61.8. All right. So here's the question. Well, Akil, we hit 61.4. That's close enough, right? Is it? No. The requirement says 61.8. Now, I would say this, because we know trading is customizable. You can do whatever the hell you want. I don't care. It's your trading. As long as you're consistent. That is my, if you guys are brand new, that is my kind of my philosophy. You can do whatever the hell you want as long as you're consistent in doing it, right? There are some teachers out there and some books and whatnot that have buffer zones. They say, hey, close enough, right? This is super close to a 61.8, so it should count, right? And I'm fine with you using that close enough rule. I know you guys are expecting me to say, no, it's black. Well, for me, it's black or white, right? But I'm fine with you using a close enough rule as long as you are consistent with it. So here's what you need to do. If you're going to use a close enough rule, simply define it. Define what close enough is. The funny thing is, if you define it, you've actually created a black or white rule for close enough, which puts you back in the black or white rule category, right? So define it. So if you're going to say, hey, if we're, I know quotes may differ per broker. I know trading is a little bit of an art. If you say, hey, if we're anywhere within 0.5, then that's close enough, then that's fine. So your requirement is a 61.3, right? So I don't have a problem with you doing that. Just make sure you define it. That way it's still black or white, but you give yourself wiggle room for whatever reason. For me, it's black or white. It's 61.8 or not. And I'm actually very happy this is not a 61.8 because this is actually going to give us, well, I'm personally happy because I value a bat more than a shallow Gartley, but I'll show you in a little bit. This is going to give us a C leg up here. And this is going to be a bat pattern, which means our decompletion is going to be right down here, right? Now, if this were a Gartley pattern, right? Let me bring on the risk reward for you guys real quick. If this were a Gartley pattern, here is the difference. If this were a Gartley pattern, your decompletion would be right here at the 786. Now, here's the thing. Your stop loss would be the same, right? The stop loss would not change whether it's a bat or a Gartley. So your stop loss for the Gartley pattern would be at the exact same place you would put it at for the bat. So this is going to be the same thing. Your targets, initial targets, are also going to be a little bit closer. What are we doing? Or a little bit further, excuse me. But the overall risk reward is going to be worse. So your target's going to be a little bit further away right here. And you can see the difference in the risk reward. If you compare your little lines here, is with the bat pattern, you have a 1.2 to 1 risk reward for target one. With the Gartley pattern, you can clearly see this is going to be an inverse risk reward, which means either you can't take the trade or you're going to need to make some type of adjustment. Now, the one positive is this, right? We spoke about the two levels. If you remember our trading view chart over here, right? We spoke about the two levels that we expect price to go to. One was this pregnant pause right here, this little retracement before the move higher. Second was the lower level right there. Give me a second here, sorry. So if you're expecting a move to this first level, right, the Gartley is going to complete right at this first level, where the Bat's going to complete a little bit below that. So the one benefit of the Gartley pattern is that if we do get a push down here and a hold or whatever, then you would be involved. With a Bat, you may just miss out. So that's a comparison between the two. But that is something to look forward to. The Bat pattern, if we get a strong move to the downside, you'd be surprised at how many times high impact news comes out, and you can go back in your charts and look at it, moves like a runaway train, and then boom, reverses right on a dime at the next relevant level of structure, or because they tend to be hand in hand, an advanced pattern formation. By the way, if you're watching on YouTube, hit that like button, please. Forgot to remind you that. Cody says, real quick, that's interesting to think about. I've thought about it as well, because some brokers' prices are different on another brokers that could have went down another 0.4. Yeah. And that's, we always say trade what you say. Thank you, Vincent. Which is a good book, by the way, if you're a beginner trader. I don't think it gets enough love. If you're a beginner trader and you're into if you're into harmonics and stuff like that, Trade What You See is a really good book. It's not a game-changing book, in my opinion, but for a beginner trader who's just learning, I think it's an extremely good book. It's a very easy read when it comes to kind of reading the market and specifically harmonics like AB equals CDs and stuff like that. I think they talk about fibs in that book as well, but really good book, Larry Pesavento, if you guys are new. But yeah, different brokers are going to have different quotes, and we see it all the time where, matter of fact, I was talking to Cherry the other day about, she did her back testing with one charting package and is doing just signed up for a new charting package. And she's got differences in not necessarily broker, but differences that the time prints were a little bit different. And she's seeing different movement on the charts. And you'll see that all the time when you go from one broker to another. When I go from NinjaTrader over to TradingView, I sometimes have slightly different quotes. It may be off by a pip or two in most cases. Again, for some reason, the Australian pairs are always a little bit more. I don't know why. But yeah, that's something you may want to take into account. And there is that artsy side of trading where, I don't think we need to be super exact with everything. We have to understand that there's going to be a buffer. I mean, because if we're think about it, if we're basing our analysis kind of thinking like the other trader, we shouldn't expect the other trader to have the same exact quote as us. Right? This is why everything works in zones. This is why when you look at Fibonacci's in general, or support and resistance, right? A good example, when I first started trading support and resistance, before I actually knew about support and resistance, here's how I measured my level. I would only take it if we hit this exact high, because that exact extreme, right, was the level of resistance. And I would see so many trades come 2 pips before it, or come to the middle of it and reverse. I'm like, well, it didn't hit support and resistance. And then you realize these are zones. So you'll notice whenever we draw things out, whether it's the VS1 levels on the Ninja charts or whether it's here, right, we draw out zones. And as a trader, you have to accept that, hey, I'm not trying to pinpoint the exact reversal. That's dumb. I just want to find the zone, and I want to look for my reason for entry within the zone. And understanding that price may spike a little bit past me, price may reverse a little bit before me, but that's always how it works. So yeah, very, very good point, Cody. Yeah, and I don't mind a close enough rule. I think a lot of people think I'm against it. I don't mind it at all, as long as you're consistent. Because if you're not consistent, then close enough is going to be based off of your feeling and what you want to do versus what you should be doing. Real quick, Cody says exactly why we have to take what the market gives us. Some of the best moves are the ugly ones, and some of the best setups are the ones that lose right away. Learning to adapt is key. Yeah, I don't know if it's a mental thing or not, but like I feel like the trades that I don't want to be in are typically the ones that work out best for me. I'm pretty sure most of that is mental. Because in my head, I'm like, oh, stupid rules get me into a stupid trade. You know, just throwing money away, right? And then it ends up winning. So I'm extra delighted because I'm like, oh, yeah, wow, like surprise. Like that, woo, whoa, thought I was going to lose. So I'm pretty sure most of that is mental. And you get the same thing with the best trades. You're so excited about the best setup. This is an A++ setup. And like you're already counting the money before it happens and it loses. So it hurts a little bit more. So most of that, I'm sure, is mental. But this is why you just got to be consistent and take what you're supposed to take, because you never know. You never know the outcome. You never know the outcome. Yeah, psychology will mess you up. That's why you gotta just become a machine. Don't favor one trade over another, and just churn them out, man. That's something I worked very hard on over my career. Is like I still do. I try my best. I still do get excited over certain setups. You guys will hear it in my voice, but I try to stay as neutral as possible. Every once in a while, I get excited. Like you guys saw it with dollar yen earlier in the year, where I'm like, no brainer, buy it. Everyone buy it, right? Got all crazy with it. You saw it yesterday with the Swiss one and even the pound dollar one. I said, this is, as soon as we got that rejection, I'm like, this is a good trade. But for the most part, I try to just assume everything is going to lose. And that's kind of been my philosophy. And just, I plan for the worst, and then you're delighted, instead of, if you plan that everything is going to win, then you're just going to be disappointed. Cody says, I think one of the best things that you said to me was always stuck is when you place a trade, act like it's already a loser. Yeah. Yeah, there we go. Look at that. Great minds. Yeah. Again, traders, think about it like, I think about it like the poker table, right? When we place a trade, it's no different than pushing our chips into the poker table, right? Like once we put our chips into the poker table, like that money's gone. Like you can't reach back and be like, I changed my mind, right? You can't reach back and grab those chips. You're placing a bet on an outcome that you don't know. Now you're placing an educated bet based on your skill level. You're placing an educated bet, or you may raise or bet more based on the probability. So depending on what cards you get and what cards are shown, those numbers, those probabilities are going to switch. They're going to get better. They're going to get worse. They may get better for your opponent, whatever like that. But at the end of the day, there's no guarantee that you're going to win any hand. So once that money is on the table, you got to just assume it's not yours anymore. And I think the more we can get that mindset down as traders, the better we'll be. Like the money's not yours. And this is why we got to kill that mindset of like when a trade is in profit and then it goes back to break even, that you lost money. No, you never had that money. You never had that money until you close the trade and you see it in your account. That money is not yours. So you can't count those money as wins when it's, only 50% to your profit target. It's not yours. Don't get excited over it. You don't have that yet. It's still got to play out. And the same thing for losses. People panic over losses because they look at their chart, they see themselves in the red, which isn't fun, right? I've been there. It's not fun. I hate it. That's why I don't look at open trades, right? I don't look at open trades because it'll drive you nuts. But people see their trades in the red and they freak out. They freak out and then they close the position. But that money's not lost either. The money's not lost until your stop loss is hit, right? What you need to look at during a trade is, well, and this goes back to yesterday. We're talking about having reason for doing things, right? Let me ask you guys this question, right? I'll start off with a simple one. When you're in a trade, you always put a stop loss, right? Right? You guys always use protection, right? Please tell me yes. Please, trust me. You'll get into trouble if you don't. Okay? Where is that stop loss placed? Is it random, right? Remember, I think it was either yesterday or Monday. We talked about the random stop losses, 10 pips here, whatever like that. Is it random or is it purposeful? Now, we may have some mixed answers on this. Some of you guys may be thinking like, you know what? Actually, ooh, let me not answer that. But it should be purposeful. Your stop loss should be placed beyond the area that tells you that you're wrong. So if we're placing a trade and my stop loss is at the area that says, hey, Keel, you know what? You're wrong. And we're not talking about 2 pips below your entry, right? If the market goes against you, we just talked about structure acting as zones, and you never know what zone is going to hold or what particular price in that zone is going to hold. But you know that in that area should hold, right? If price goes into the red, but it hasn't invalidated the integrity of the trade, which when I say integrity of the trade, that means the reason you got into the trade, or the levels that should hold in the trade. Why do we assume that we're going to lose? If your trade is based off of an important level of structure holding, and your stop loss is beyond that important level of structure holding, and maybe you entered at the beginning of that structure level, and now you're in the red by a little bit, but price is still churning in that structure level. Has anything changed? Has the market done anything to tell you that you're most likely going to lose? No. So why are we panicking? Why are we panicking? Right? There's no need to get frustrated over that. Now, if the market breaks and violates that level, now it's like, well, that was my safety net. We just blew through that. Now the probabilities have shifted. I'm picturing like numbers changing in your head where it's like you have a 70% chance win rate, and then like level of structure broken, it goes 20%, right? abort, right? One of those things. But until that happens, there's no need to panic. And this is why we need to be good chartists. This is why we need to be good analysts, because the better you are as a chartist, the better it will help your psychology, right? Trading psychology isn't just kind of sitting there and closing your eyes and visualizing and mindset and yoga and humming and all that fun stuff, right? It's not just positive affirmations and walking over hot coals and all that fun stuff, right? Give me 1 second, guys. Hold on. Gotta plug my laptop in. Sorry about that. Very, very awkward pause. Very awkward pause in the middle of a conversation, but don't want this thing to die because I did get some questions on YouTube. But trading psychology is about doing analysis. It's about knowing what signs the market can give you to tell you that, hey, I'm more likely to be right or I'm more likely to be wrong. And that allows you to do more stuff. That allows you to do graceful exits, where if the market tells you that your probabilities have went from 70 down to 20, maybe I bail because I'm more likely to take a loss. So I might as well take a smaller loss. And taking a smaller loss is basically like a win. Trust me. If you got what, 2% at risk and you get out for 0.5%, boom, that's a win because it wasn't a full loss. Or maybe the market tells you something where it's like, hey, this thing's moving in my favor. Now I have a new level that tells me that I'm wrong. Well, now what can you do? Well, you can get that risk down to break even. You can get that risk in the profit. It allows you to do these amazing things. So this is why I'm such a big fan of like, just learn price, learn how to learn to be a chartist. If you're going to use technical analysis, learn to be a chartist. And I don't think a lot of us do that. A lot of us just learn how to find patterns or setups or whatever it may be. We don't actually learn how to read a price chart. And we're missing a foundational skill. Real quick, Martin says, but as long as you stick with one broker and one system, it shouldn't matter. True. Yeah. But the point that Cody was trying to make is that, because on the charts, the candlesticks are a visual representation of all the market's participants, and that we can't assume that just because our chart shows structure at 0.9901, it may be 0.9902 on someone else's chart. So yes, for our purposes, we want to trade what we see on our perspective. But he was saying more so like, hey, things do work in zones because this level may be important. And although this particular price point may be important for me, 1 pip above, 1 pip below, whatever it may be important for someone else. And then multiply that by millions of people. Real quick, Akil, are you self-taught or did someone teach you how to trade? I was coached and mentored. I tried for a while by myself, stubbornly and unsuccessfully. I started off in the stock market. I had a really, really good success in the stock market. Not as a technical trader. I went to Forex because I can trade with less and I could make more in a shorter period of time. That's what I was sold, at least. And I thought I can just pick up and play it. And I learned the hard way that technical analysis is a completely different beast. The Forex market is a completely different beast. So I had a pretty long learning curve. But eventually I kind of curved my ego and said that I need help because I was bleeding. I was profusely bleeding money. And I got help. I got coached. I got mentored. I still failed for a pretty long period of time because I was still looking for the shortcut. Right. I thought that all I had to do was like, hey, once I sign up and pay for a course, then my results will turn around. Right. And I didn't realize like you actually had to put in the work. I was still looking for the thing. And it wasn't until I started focusing on just learning how to trade that I started seeing results. But yeah, I did have a mentor. Did have a mentor. Real quick, just going through, just learn the Elliott wave theory and you will do just fine. Yes and no. I won't get on a whole rant about Elliott waves, but I can tell you this. I guess first and foremost, I don't poo-poo anything in the market. Like I said before, I can care less how anyone trades. All that matters is your bottom line. Like, are you making money? Right? If you guys ever read the book Market Wizards or any of the books in the series, right? Market Wizards is a collection of the best traders of all time and interviews about how they became successful. And there was 2 valuable lessons I learned from Market Wizards. One, all these guys sucked, right? I don't know how many of you guys have read Market Wizards, at least the first one, right? It was so, I sound like a hater, right? It was so refreshing to hear how much these guys sucked. I think all but one guy like never lost a trade ever. He just came out running, right? But everyone else sucked. And it was cool because I read this book while I sucked. And I remember reading this story. It sounds like such a hater. Reading this story about this trader, and he blew all his money and he went to the back stairwell of the office. He had to call his mom and ask for a loan so he can get back in the position. So he's like crying and begging his like, Mom, can you give me a couple $1,000 so I can get back in the position? And I'm reading this. I'm like, yes, this guy's a loser. He's worse than me. I thought I was the worst. Sounds horrible, but at the time when you're bad, like, you don't hear any stories on the internet about people struggling. Everyone is just the greatest, right? So like to hear that people struggled, I'm like, yeah, this is cool. But the second lesson I learned from Market Wizards is that it doesn't matter how you trade, you can be profitable, right? People use fundamentals, people use technicals, people use harmonic patterns, people use support and resistance, people use astrology, right? People use the almanac, right? It doesn't matter. So yeah, you could be quite profitable trading Elliott waves. You can be quite unprofitable trading Elliott waves, just like anything else. For me personally, I understand Elliott waves. I understand the role that they play in the market. I'm not personally a fan of using them in trading, aside from, again, the general knowledge of how the market moves. But as far as like counting waves, I've never been a fan of that personally, just because it is extremely difficult to consistently, and again, if you have a rules-based reason, if you've dedicated time to doing it, you will have a consistent way. The problem I have with it was a consistent way of identifying waves, especially with how the market moves in fractals, which means moves within moves within moves, and stuff like that. But again, if you are dedicated to Elliott waves, just like if someone's dedicated to advanced pattern formations, you found a way that works for you. And you've tested it. It's testable, verifiable, repeatable. You can trade it for a profit. But I wouldn't just say just learn Elliott waves and you'll be fine. I wouldn't say that for anything. I would say that for maybe just general technical analysis, but not specifically Elliott waves, not specifically patterns. Probably the only thing I would say that for is like support and resistance. if you just learn support and resistance, that will help in many, 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 many aspects. Because support and resistance are basically target levels for everything. My homeboy said, "You look like me, so now I'm here." Nice. You must be a handsome looking man. Yeah. What pairs do I trade? So I'm getting some questions on YouTube. I'm gonna kick these guys out soon. Don't worry. You see on my right hand side of my screen, you'll see it says my portfolio. These are the 9 pairs that I personally trade. There, got a few more questions. I like your style, very relatable knowledge. Thank you. If you like it, hit that like button and subscribe if you're new. Oh yeah, supposed to tell you guys, we got a workshop coming up as well. 1 week free online workshop, November 14th. There's a link somewhere probably that you can sign up for it. TimberTrading.com. There we go. I'm bad at the promo stuff. Real quick question. When will you officially go on vacation in December? And when in January will you start trading again? So by vacation, it's not actually vacation, but when do I go on, when do I shut down my trading? I got to check what news events we have, but typically after the first week of December, I'm done my personal trading, and then I give myself 3 weeks of continued education. So that's when I review everything and get all the business stuff intact. And typically I either do a session of continued education where it could be a book, it could be a training series, it could be going through old training series that I have, or kind of strategy development and or back testing, where I kind of dedicate 3 weeks to working on a strategy, developing a strategy, back testing something, or whatnot. And then we, again, got to look at the calendar. We typically come back, either the first or second week of January, depending on when New Year's ends or comes out. All right. Couple more questions. This is a good one. How many pips do you shoot for per trade? I shoot for as many pips as what's available. So there's no pip amount. I shoot for what's available with the trade. So I do analysis and I say, if this goes in my favor, here's where I expect price to go to next. That's how many pips I'm shooting for. So there's no point in saying I'm shooting for 100 pips or 50 pips. You shoot for what the market can give you. And how do you know what the market can give you? Analysis. Work on your skill of making predictions on where price is likely to go based on the trading opportunity. Again, massive problem that newer traders face is they don't know how to take targets. They either take targets at bad locations, meaning too little or too late, or they have no actual reason for taking targets. It's all emotionally driven. And there is a study that proves that. It's not taking trades. That's not a problem with most traders. It's getting out of trades. What can you say about the FX market this year, 2022? Fundamentally driven. Very fundamentally driven this year. By lots of it. It is a very interesting time. We've got interesting times ahead of us. I can't remember a time where we've had more going on in the global economy, between wars and politics and inflation, and there's a lot going on. The cool thing is this is going to offer some very good opportunities because there are some markets that are at some very interesting places. So we're going to talk all about that from a technical and a fundamental perspective in the upcoming workshop. So make sure you attend that. We're going to bring in a fundamental analyst to give his perspective on things, and we're going to take it to the technicals and kind of bring the two together. But all right, too long of a live session. We get these every once in a while. Okay, YouTubers, I'm kicking you off. Trading viewers, I'm kicking you off. Sorry for that. You got 45 minutes, so you got a bonus. Because of that bonus, you owe me a click of that like button. So make sure you do it on your way out. I'll see you guys tomorrow, same time, same place. Live rumors. You guys got anything interesting on your radar?